Welcome, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer, as a point of reference. We expect you to make your own financial decisions and come to your own financial conclusions. Today is Sunday, August 8th, 2021, and this is Blockhead Traders Weekly. In this week's episode, we're going to take a look at an example of rolling an option trade. But before we jump into that, I want to give a shout out to two very useful resources that you can find a link in the description below. The first is a link to our Discord channel where you can chat live with myself and other fellow Blockhead traders throughout the day. And the second link is a open trade journal at thetagang.com/sprocket888, where you can see each and every trade that I've ever made, good, bad, and ugly. And now on to this week's episode. So in this week's episode, we're going to talk about rolling your option trade. Now, you might have heard somebody say, hey, I'm just going to roll that forward to the next month, or hey, today's my rolling day. I'm going to take all my positions and roll them forward or close them out. So we're going to take a look today about what rolling actually is, and we're going to give a real live example of a roll that I just completed this past trading week, and we're going to talk through it. And there's some caveats that you should know about when it comes to profit and loss with respect to rolling the particular option trade out there. So let's take a look a little bit about the roll. So what exactly is a roll? A roll is very simply taking a position in one expiration cycle and moving it to the same position to another expiration cycle that is further out in time. And a roll is actually two separate transactions that are often bundled in one to come up with the name roll. You can do these two completely separate, but a lot of times when you're actually doing the roll, you'll enter the order such that both transactions fill at the same time. And the two transactions that are happening here, the first one is actually a transaction to close your position in the front month, or the month that is in the current expiration cycle. The second transaction is a transaction that is opening the same position in a later expiration cycle, or known as the back month. You can do this with short positions or long positions. You're essentially, to close them, just doing the opposite of whatever it was that you got into it. And then, of course, opening the next one is the same thing that you did in the front month. I typically only ever roll short positions, and often they're short puts, although they could be short calls, but it's very seldom that that is a situation I get into. And I also only do this when I can receive a net credit. There's no real reason that you have to receive a net credit. You can do it for a debit, and depending on the type of roll, that might be more than likely. But in my particular trading style, when I do rolls, I am doing so and collecting additional credit while maintaining the current position just in the future expiration month. So let's go ahead and talk a little bit more about a specific example. This might help a little bit. So I recently, last week, rolled a position in CVAC. So I have a short put on that position, and I opened that short put on July 1st. It was opened for the August monthly expiration cycle, and I opened it for a $9 credit. I rolled this position on August 3rd. So roughly I held the position for about 32 days. And when I did the roll, I bought back the short put to close that August position, but the position wasn't quite profitable yet for me, and I wanted to maintain my thesis on CVAC. And so I wanted to extend the duration of my trade. So on August 3rd, I then sold a short put again with the same strike as my original short put, except this time the expiration was in September. So what happened here is that original $9 that I collected, that was all extrinsic value, and that was slowly decaying over time. So 32 days to be exact. And when I went to close it, there was significantly less theta left in that option because it was close to the expiration cycle. It was about 2 weeks out from expiration. So there still was some theta left, but considerably less than when I opened it. So that made that particular option to buy it back a little bit cheaper. Now, the front month that I was selling, or sorry, the back month that I was selling, so going into the September expiration, that was a significant amount of time still, over 34 days to expiration when I sold that put. So there was a lot of theta in that. So essentially, I was buying back a little bit of theta, but then selling a lot more theta in September. And the combination of that creates what's known as a net credit. Now, when I did the roll, I was actually in the money on the short put. So the cost of buying back that option in the August expiration cycle was quite a bit more than my original credit. However, because I rolled it forward, that intrinsic value is a wash when you do a roll, because the intrinsic value is just the difference in the option price, or the option's strike price, to where the option or where the underlying is trading at. So if you're $1 in the money, there is a $1 intrinsic value in that option. And because I was paying that intrinsic value to close my August position, when I turned around and sold the position in September, that September strike was the exact same distance in the money. So I basically sold that intrinsic value back, or received a credit from that intrinsic value when I sold the September expiration. So really, when you look at the numbers, you might think that it was bad because it's cost more to close that August position. But you have to remember that increased cost, a chunk of that is really due to the intrinsic value. And I got all that money back when I sold that September expiration, and the intrinsic value obtained in that. So let's go ahead and take a look on the Thinkorswim platform to put some of these numbers and maybe show you a little bit more about that trade. So going to the Thinkorswim platform, I have this trade history filtered down. You can see on July 1st, I opened this trade for a $9 credit. Now, the nice thing about the way this is showing you here is it's going to show you the individual trades. So this first one is my my sell to open, where I collected $9 credit. Now, you can come up here on the August 3rd trade and you can see two transactions. You see a buy and you see a sell. And what you see here is you see a buy to close, CVAC, 20th August 21, 65 put for 1180. Now, this is closing this initial position that I opened for $9. And what you'll have here is you see I collected $9 on the trade initially, but when I went to close it, I had to pay $11.80. So this actually is a loss that I'm going to book in the month of August on my brokerage trading account. So a lot of traders will show you the end result of all the rolls where they hope to be net positive when they consider all the past trades. And sometimes it's not really clear, but you are actually booking a loss on your brokerage trading account at that time. So you hopefully will make it back when the next option goes to expiration. And we'll continue on with the thought process here, but just keep in mind that this is a completed trade. So the fact that you roll it doesn't necessarily keep the trade alive from the standpoint of gains and losses on your portfolio. And what you'll see here is then I opened sell to open one share of CVAC 65 put for $13.50. So I can't remember exactly what CVAC was trading at on August 3rd when I made this trade, but the increased cost here is because CVAC was considerably in the money by a lot. And when I sold the one in September, that was basically a wash because I got back the intrinsic value that was present when I closed the CVAC in August. And what you'll see here is a net credit of $1.70, which basically means for the overall trade that I have going here, I collected an additional $1.70 in credit to the original $9. Now, this can seem kind of confusing, which is why we've talked before about keeping track of your trades in a journal, because the profit and loss graphs in a lot of these brokerage firms do not take into account or remember some of the historical trades that were involved in your chain. So what I'm going to do here is I want to open up my trading journal. And in my trading journal, I want to talk about how I happen to track the CVAC. So I will filter our list down just to the CVAC trade. And these are all the parameters that we've talked about in previous episodes. And the part that I want to call your attention to here, and why I want to show you that there's a little misleading thing when you look at your brokerage P&L once you've rolled. Your brokerage P&L is great while you have your initial trade open, but as soon as you start rolling trades, your P&L in your brokerage account can be misleading and not representative of your actual P&L overall on the trade. So right here, you can see my original CVAC credit of $9. Now I keep track of my rolls and credit here, and I added $1.70 for that recent roll. So in total, I have collected $10.70 in credit. Now I'm hoping my close target is to be able to close this position at 535, and my bailout price is 32.10. Not going to get into that. We've talked in past episodes about that, but what I want to do is I want to go to my trading platform and I want to show you where CVAC currently is and what that P&L looks like, and you're going to see it doesn't quite match. So here we have my P&L chart, and here is the CVAC. Now I'm going to add an analyze closing trade here of $10.80. I'm not going to show it on the P&L graph because what's important here is, if you remember from the chart that from the spreadsheet I just showed you, I collected $10.70. To close my position right now would cost me $10.80. That is a 10-cent loss. But if you look at my P&L chart, it's showing me that I have a $336 profit on the trade. And if I actually go to the main brokerage window and I look at the P&L here for CVAC, it actually says that I'm 25% up on the trade. And the reason for this, and this is oh so important, that when you start to roll, you're keeping track of your past credits, because this can be misleading and it might lead you to say, I'm going to take this off the table right now and book my 25% profit. The thing is, that's only a 25% profit if what you've done is only considering that you sold the short put at $13.50 here. These other transactions are not reflected in this P&L in the Thinkorswim platform, or really any platform all has this handicap. There is a feature in Tastyworks called order chains, and they attempt to solve this deficiency so you can kind of keep the trade alive, if you would, on your P&L chart through those order chains. And I'm not going to get into that in this video, but that is one platform that kind of takes care of this problem. Otherwise, you really need to keep those sheets available. So if I go back to the P&L chart, what I have to do now that I know that this trade has been managed. So whenever I do something to a trade, roll it forward, shift the strike price, anything like that, that trade has been managed. And from that point forward, I basically have to keep in mind and pay attention to my spreadsheet for my tracking of my profit and losses. So one of the things that I often do is I come in here and in my form, I have a break even. So my break even is at 54.30. Okay. So what I'll do is, in my brokerage account, I will come back, and one of my price slices, I will typically add my 54.30 break even price. So let me drop these 10% because I don't really need them. So this is important because this is my real break even on the trade, not this lower number. And again, if you recall, one of my trading strategies is my bailout price is set to 2 times my credit received. So if you look here, you might think, oh, just set your credit or your bailout price to where you have a $2,700 loss. But that should be set from the original trade. If I take a look back at my trading journal here and I come to my bailout price, that's going to be 32.90. So going back to my P&L chart, I will add another price slice, and this price slice I will set to my 32.90 bailout price, and it's going to be quite a bit down here. But you'll see the loss down here at 22.90 is, or 32.90 is around $1,800. Now remember that bailout price is set from my initial credit received. So this is misleading because I didn't really receive a $1,350 credit here because of the roll. So that is basically rolling in an example of CVAC. What this allows you to do is collect additional credit while you're waiting for your thesis to play out. And as long as my positions don't reach my bailout price and I still feel confident about my thesis, I will continue to roll them forever until they either prove my thesis incorrect and I have some reason to change my mind and I will exit for even a loss at that point, or I will also exit when my bailout price is hit, or I will hang on to the trade until it reaches the profitability that I'm targeting. Remember, it's very important to keep track of your net credits and your net debits on a worksheet so that you know where your bailout price actually is, because once you start managing your trades, your brokerage platform P&L might not appropriately reflect those bailout prices. Now, one other thing to mention in this video, and I didn't really bring it into this example, but it is something that I will do. You might hear a rolling down or a rolling up. So when I rolled that CVAC, the closing position or the underlying position was probably around the mid 50s. So it was legitimately probably $10 in the money when I made that roll. One of the options that I could have done was make the strike in September lower. So I probably could have moved that strike down $1, not quite $2, because I only ever do this for a net credit. But what that would have done is I would have taken the 65 strike to a 64 strike. That would have been $1 more or $1 less in the money. So that net credit would have dropped to 70 cents. Now, I couldn't go to 63 because that would have been $2 less, which would have had that roll going for a 30-cent debit. And one of my rules is to basically only roll for a credit. But when you hear somebody saying, I rolled it down or I rolled it up, what that basically means is they're combining, not only moving the position to the next expiration cycle, or a future expiration cycle, but they are also adjusting where that strike is. So if I rolled down, I would be taking the 65 put in August, moving it to a September put expiration, but maybe lowering the put to a 64 or 63. That would be rolling down. Rolling up would be the exact opposite of that, where I go from the August expiration to September expiration, but I move that strike from 65 up to a 66 or 67. That would be rolling up. So that brings us to the end of this week's episode about rolling positions as an example. I hope this was helpful to you. If you have additional questions, feel free to leave them in the comments below. Hop in our Discord, ask them there. Hopefully this was able to show you that rolling things is not really that complex. It's not really that tricky. It's just a matter of closing one position and opening the exact same position in a future expiration cycle. So good luck this week in your trading. Hope you guys all have fun. Good luck. And remember, think outside the block.